Ever since Ark Invest fell by a whopping 50% from its 2021 all-time high, many investors have sold their holdings and ditched the fund. Ark's main ETF, which was managing almost $30 billion at one point, has seen that amount drop by more than half. Today, the ETF manages about $12 billion. Whatever happened to Ark must have scared the investors, especially now that the prices have dropped significantly. Many of those investors are now shorting their holdings in Ark's ETFs. This makes little sense as lower prices usually lead to higher expected returns in the future. Hello and welcome to today's video, where we'll be looking at why Cathie Woods, CEO of Ark Invest, believes that now is the best time to invest. Stick around till the end to find out why Cathie Woods thinks this period is similar to the dot-com bubble and what that means for people like us. Unlike many others, Cathie Woods, CEO of Ark Invest, seems to think that this present price point is offering some of the largest investment opportunities in the stock market's entire history. Many investors have compared Ark Invest to the stocks of internet companies in the dot-com bubble. According to Cathie Woods, Ark Invest's current position is like the dot-com bubble. However, the roles are reversed. Internet stocks kept rising during the dot-com bubble, whereas the value stocks experienced significant crashes. As soon as the dot-com bubble passed, value stocks resurged compared to growth stocks. The graph on the screen compares the returns of Nasdaq with Berkshire Hathaway from the year 1999 up until 2004. The Nasdaq experienced a major crash while Berkshire Hathaway saw its value rise steadily. For Cathie Woods, this is a similar position that Ark Invest finds itself in. However, she believes that the roles are reversed. For her, 2022's innovative stocks are the value stocks of the dot-com bubble, while the 2022's value stocks are the internet stocks of 1999. Of course, this sounds wild, but the performance spread between both funds has very little difference. Since the past year, Ark has lost roughly 50% of its value, while Berkshire Hathaway has increased by over 30%. Cathie has pointed out that the ratio of new lows to new highs has been at the highest since 1999. In 1999, the value stocks reached new lows as everyone jumped on the internet train. Since the past year, our kinds of stocks have been reaching new lows while value stocks were reaching all-time highs. Most people would agree that the best thing to have done during the late 90s when the ratio was acting the way it was to ditch new highs and move to new lows. And Cathie believes the same is true of today. Price movements are undoubtedly interesting to read, but there's no guarantee what goes down must come back up. However, it is worthy to point out that the economic activities in the background are setting Ark Invest up for a massive rally in price. It's no secret that the Federal Reserve has agreed to raise interest rates in March this year. Most economists are willing to bet on a 25 base point rate hike or 0.25%. But some are willing to bet that the Federal Reserve will hike the interest rates even further. Some other traders believe that there's a 30% chance that the Fed will go for a 50 basis point rate hike or 0.5% rate increase. Many of them are betting their predictions on the latest job report, which shows that the government increased more jobs than most people expected. Most economists and analysts expected about 150,000 new jobs by January. However, the US economy doubled that number to nearly 467,000 new jobs. That considerable difference signals that the economy is particularly robust at this time. Unemployment rates have also remained at 4%, which is also a positive. The chairman of Federal Reserve, Jerome Powell, gave an interview where he explained that the economy's strength gave a lot of room to raise interest rates. The funny thing is that many economists and other financial institutions compete to predict higher interest rate hikes. Bank of America has claimed that it expects 7 rate hikes in 2022. One rate hike is about 25 basis points or 0.25%, which means 7 25 basis point rate hikes would be a 1.75% increase. Even for a bank, that statement is a very bold one. Bank of America pointed to the Fed's statement that it was behind on raising interest rates as a sign of future pain to come. And all of this has been going on while the growth of money has begun to slow down. M2 money, which includes cash, checking deposits, and easily convertible money, has been on a steady monthly decline. The expected interest rate increase in March 2022, plus the fear of future rate increases, are beginning to reflect in Ark's valuations. If and when inflation cools off, growth stocks will be in a great position to rally in response to these types of rate increases. For many, the most crucial question is how many rate hikes will be enough to reduce inflation. On the other hand, Cathie believes that there's a lot of exaggerated fear around the rate hikes. She goes on to say that not many rate increases will be needed to reduce the pace of inflation. This she attributes to other economic factors that will affect how the Fed chooses to act. After seeing today's employment report, many are convinced that we are in for a 50 basis point increase. According to them, this will be Fed's message that it means business this time, and also that it will tackle inflation. Even if they do that, the signs are already clear that they don't need to do much more. Another issue is the fact that this year is the midterm elections. The Feds like to maintain a position of political neutrality, so they like to keep out of political issues. So they might agree for the 50 basis points, even if it's just to say, okay, we're done for a while. This is fascinating because strategists and financial analysts try to beat each other to the correct prediction. Some are saying, okay, I think it's at least 3 more tightenings after that, or 4. Some have even put that number at 7. According to Cathie, the equities market reaction is fear that the Fed is going too far, too fast. Cathie goes a step further by saying, the economy is quite weak and I think the Fed could do it, overdo it quite quickly. All this means one thing. If Cathie gets it right and the Fed doesn't raise the rate as much as people think, the ARK will experience serious positive readjustments in the valuation. If the Fed chooses to raise the rates by 50 basis points in March, that will present a wonderful opportunity to buy innovative stocks. This would make Ark Invest's future outlook positive, as interest rate increases in the future may not be needed. Remember Cathie's .com analogy? Value stocks have been on a steady rise month after month. Despite the latest sell-off, Ford stock is still at a 5-year high. Stocks of finance and energy companies have been rising over the past year. The Vanguard Financial Index Fund has been up by 28% over the last 12 months, while the Vanguard Energy Fund is up more than 50%. Obviously, such increases cannot be sustained for slow-growing stocks, and this points to a gigantic bubble for value stocks built upon the fear that the dot-com bubble was happening again. According to Cathie, Ford's upward movement is a great sign of the value bubble. Quote, I was very interested after Ford said that the demand of its F-150 Lightning EV was so much stronger than it expected. Its stock exploded. Now, I want our auto manufacturers to be very successful in the EV space. But to see its stock jump to highs that it had not seen since 2000 is a sense of what I just said. What those moves said to me is, oh my goodness, investors don't understand that 97 to 98% of its sales is gas-powered cars. And we believe that the shift towards electricity is accelerating here. Oil prices are one reason, but lower prices are another as battery costs come down. So I found that very interesting in the context of the juxtaposition of the late 90s against today. Interest rates are about to increase, and most, if not all, believe that this will harm Ark Invest in some shape or form. End quote. Cathie has gone on to say that she believes that only big tech companies will be hit in a major way by increased interest rates. According to her, smaller innovative companies can outgrow hikes in interest rates. For instance, a company is growing at 50% per year and the interest rates are increased by 2% with lower valuations, which would reduce the power of compound interest. But it would have little to no impact on the company's long-term success. While if a company were growing at 50% annually, a 2% interest rates hike would hurt the company in a major way. If a company grows at 50% per year over 10 years, discounted at 10% per year, its revenue would increase by at least 28 times. When discounted at 15%, the company's revenue would only grow by 20 times. The difference is significant, but it is still nothing compared to the impact of a company growing at 15% a year. A simple way to calculate how long it'll take for a number to double is the rule of 72, which states that 72 divided by the growth rate equals the number of years it takes for the number to double. So say a company is growing its revenue at 15% per year and is discounted by 10%, the company will now grow at 5% per year. Thus, 72 divided by 5 will give you 14.4 years. And that would be the amount of time it'll take the company to double its revenue when it's discounted by 10%. Cathie believes that she has identified a signal that points to the huge impact that the companies would face because of increased interest rates. And this has started showing up in the valuation of private and public companies. The public market has been toning down its valuations while the private market has increased. This, Cathie believes, could result from private investors knowing that increased interest rates won't have much of an impact on valuations. After discussing these issues with their value investor friends, Cathie adds that most of them agree that mature growth companies facing a bit of competition would be most affected by a 2 to 3% increase in interest rates. Cathie believes that we are in a similar situation as the early 2000s with the emerging growth, and that private companies have sensed it, and that's why private market valuations have gone up over the last year. Many investors who put their money in Ark in 2021 are now ditching the fund, but that's the exact opposite of what they should do. Because as the author of The Intelligent Investor Benjamin Graham pointed out, when the market is overly optimistic, investors should look to exit their positions. When the investors are very pessimistic, there's a good time to purchase stocks. All of this doesn't guarantee Cathie is correct, but if she is, there'll be a lot of investors crying that they removed their money from Ark at the wrong time. There you have it, guys. We've gotten to the end of this video. Go to the comment section and tell us whether you think that Cathie is right about the interest rate hikes. If you enjoy videos like these, make sure to like and subscribe so you never miss out on the latest.